Wow. Have not stood at the William Penn in front of all of you in such a long time. This is kind of a surreal moment. So I want to welcome everybody back in person for an excellent event.
Yep.
I want to start by saying I have some good news and then I have some exciting news. The good news is we don't have a 30-minute presentation on our business anymore. I know how tired you guys all became of that. The exciting news is 2025 is Financial Independence Planning's 30th anniversary. That's good. I just want to say, obviously my dad somewhere, I've watched this whole journey from the basement of a townhouse with one person to now 30 people and helping over 800 families worry less, enjoy life more. It's really been such an incredible journey and something amazing to watch. So give a round of applause for my dad. 30 years of really fun and great business and really taking care of people. Something I talk to my team a lot about, and I hope you guys feel, is when we do our reviews, when we talk about financial planning, we understand there's a lot of investments and tax decisions, insurance reviews, we review your wills. We pride ourselves in this comprehensive approach. But what I tell my team is I tell them, I go, take a step back and think about the organization you're part of. I know we all think, you come to work at financial planning office, and you do, but what do we really do? We take care of families. We have 800 families, and I know our experience with you guys is showing you that financial plan, giving you confidence. Your assets will last the rest of your life, and you can maintain your lifestyle, or what you need to do to have your assets last the rest of your life to maintain your lifestyle so you can truly have better lives. You guys have all worked so hard. And it's been such an honor for us to be the trusted relationship, to be by your side the rest of your life, to have these amazing lives and amazing retirements. So I just want to thank you all for allowing us to work with you. And what I'm also going to say is what I promise, because, HK is obviously not going anywhere, but I'll be assisting and leading the team in our future. The next 30 years, we are only going to continue to work harder for you, do better planning for you, and always have the best client experience possible so you guys have the best lives possible. Updates. Our team has grown, which we're very proud about. We've brought on a new marketing assistant. As you guys know, one of the greatest things about our experience isn't just the planning, it's how else can we have this wow experience for our clients. I know we all love birthday cookies, me too. I wish I didn't eat them all in one night. Iron Picks baseball games, but all these great educational events where we're continuously with our marketing team saying, how does our experience get better? How are we more than financial advisors? How do we have these people, our clients, come to great events, get great education, spend time with their family, and it's because that we're providing this great experience. So we hired a new great marketing associate, a new client back office client service representative. In addition, really exciting, many of you in here work with, maybe Ken Souter, Glenn Kopensky, Barry Blatt, and Fred, but we have Keith, thank you. We have 3 new financial advisors working with us. One of them is here, Victor Dean. And they, shout out Victor, great job, Victor. And what's been amazing is that their training, I've been assisting in training them, is that we have this unified client experience and service model that we hold ourselves to the highest standard. So when we've trained these new advisors, it's our brand represents the highest level of client experience, and we want, no matter what advisor you work with, the same amazing client experience. Everybody gets a financial plan. Everybody has that real feeling that we're on track to our goals, and of course, great online access to view your account. So we just have 3 new amazing financial advisors to take us into the future as well. Really sharp people. Lastly, the other quick update is we hired a chief operating officer. So all of these things, because again, we feel we are this really great company, but every year we look back and go, how do we get better? Because that's what we want to do. I mean, the impact we have, and I'm sure many of you feel this way on our calls, should be exciting. We like talking to FIP. They make me feel like I am in great shape. I can take the vacation. I will be okay as life does move forward. And we want to help more families because we know the amazing impact we have in all of your lives. I should stop talking, right? Because I can keep going,
You're not quite to 30 minutes.
Yeah, I know, not in 30 minutes. Anyway, I just am so happy to have you guys here. I'll talk one more minute. Two amazing speakers. Mick and Dan are phenomenal. American Funds and PIMCO, I couldn't say enough about their investments. I'll speak very briefly on investment committee. Our investment committee, we meet monthly. You guys all know this story. I probably say it 100 times. The average fund, minimum of a 20-year track record. So we see the fund's ability to handle volatility, recover and maintain good returns over long periods of time. And we all know over 20 years, we've had significant volatility. Many of the funds have 30, 40, and Mikkel mentioned, American Balance, 75-year track record. What I love about our investment philosophy is the transparency. You guys log online, you see your 60-40, your 50-50, you get the model, you get why that's your allocation. You did the risk tolerance and you understand how that model is made up. 20% in each fund family, long track records, highly rated mutual fund, Morningstar ratings. So the transparency for our clients to log online and understand their investments. And of course, our investment committee meets monthly, making changes as needed. So we have a phenomenal investment philosophy, and we're going to continue to improve that, and with great partnerships like these gentlemen. So again, it's such an honor to be in front of you guys one more time. We promise to continue to only work harder for you. I need everybody in this room to have the best life possible. That's what the partnership with FIP should be. It's these team of people help us have better lives, and it's such an honor to work for you guys. I'm going to bring up Carolyn Cho to give some updates and introduce our speakers. Hope that wasn't too long. Go Birds!
I'll stand over here so you can see. Hi, Dan. Thank you, Jared. And again, I'm the only thing standing between you and the main attraction here, which is the wise words and forecast, right? We're all intent our hopes what 2025 will bring for you. Right. And while it is Chinese New Year, it happens to be started 2 days ago, it's the year of the snake. And the Chinese don't believe the snake in any wily ways. It's supposed to be a very, very propitious year, a very lucky year. So we're keeping our fingers crossed that the Chinese know something we all don't, that it's going to be a really lucky year. But I do think that after looking at the slides, we're going to be, I think it looks like it's going to be good news. So I'm happy I got a preview of the slides. So, but I same thing as what Jared said. We were a little bit nervous about doing this in January, economic forecast, because you don't know what the weather would be. And then 2 weeks ago, we were saying, oh my God, goodness, the gods are not behind us, that's why it's snowing. But we do have a lineup in your packets there. If y'all got a packet, if you open up for a second, please take a look. This is your homework. I was a professor in Chinese, and that's really a lethal combination. And if we open it up, on the left side is our new brochure. So those of you who are our current clients, and of course it's died on me. That's how I do it. Don't know what happened. I was talking with a very loud voice. Sorry about that, but if you could get that fixed before our speakers speak, that'd be great. On the left side is a evaluation form. And those of you who have been to our seminars before, it looks a little bit, but we did upgrade it, and we really would like to get your opinion on not only the speakers, but some other topics that would be top of mind that have changed in the last 4 or 5 years, right? Ever since the pandemic, lots of new topics to think about. Whether you want to think about retirement communities, you want to think about, Roth conversions, whatever topics that really you're thinking about. or things for your kids, like if they've been downsized, what do we do? If my son, who's vice president at Merck, has been downsized, what should they be thinking about? So we can offer some topics like that. Yeah. Okay, apparently I'm such a good one. It's not on, it's still on. I'm a moderate Goomba, it comes with size. So that's something we want to do. We have, a wonderful event next weekend. We'll be right back here. So if you have friends who are single, who are recently widowed, certainly, invite them and let us know. We'd love to invite them to our Galentine's. We started with 12 widows, about 10 years ago, and now we have about 60 attend the event. So again, it's something that we know it's a tough time, we know, for many of our single ladies, and we certainly want to be able to be there with them, partner with them, and celebrate that. And then there's a whole host of other events that's on the right side of the packet, and then inside, so that none of you have to raise your hand and say, I can't see the slides. We have slides in the packet as well for you. So you take notes because there will be a quiz. All right. Anyone who gets 100 gets to take my children home. Then, but again, please take a look at the events. There's some very interesting topics that we're going to have for the rest of the year. Obviously, tax planning is very important. There's going to be a lot of new stuff for taxes. And then a lot of other fun events that we're having. So there's gardening. We have that head of a very large gardening group here. Hopefully she can wax poetic at one of our talks soon. So, and Karen, I won't embarrass you again with all your wise words in gardening. And we have Ariam Takes, one of our most popular events. So it's a family event. Those of you who have not attended in the past, mark in your calendars and bring your families, and maybe one of your lucky ones will get to do the first pitch. And also catch some balls. So I think Harry, your granddaughter, right? Harry and Susan, your granddaughter caught the ball last time. So it's just a lot of fun events that we have. And then if you're down at the shore, we have a couple of tiki boat events where we do not believe in prohibition. It's a very fun event with lots of fun things flowing during that time. So down towards Atlantic City. And I think the boat this year will leave from Ocean City, but it's about a 2-hour cruise that goes around the bay, and it's just gorgeous, and it's just a fun time. I think who has been to the tiki boat before? Anybody here? Oh, Tom and I think Karen, you've been on a tiki boat. Yes, it's a
lot of fun.
Yes. So those are some of the fun events for the year. And last but not least, it is because it's our 30th anniversary. There's some major charity events. There's one. That we really encourage you, even if you don't think you can do it, I encourage you to join me on a 5K. Yes, I know you're laughing. So you can hobble along, you can walk along, or you can do the 10K if you think you're up to it. So it was Michael is heading that effort up in Manna on Wayne. You'll be right here in Lansdale as well. So it's part of our charity event for the 30th anniversary. So any questions on the events? Because if you do, just ask Mike, don't ask me. All right, so that would be, I think that's really it wraps up. Oh, you on that? Oh, great. Well, I'm done now. So, without further ado, I think Nick, you are up first. So Nick comes from Vice President of American Funds Capital Group. He has spoken to some of you and addressed this group before. And he has, I don't know, I'm probably aging you, at least 25 years of wisdom, right? Oh, 30. Oh, wow. Okay. Well, I want to let you know that he has also, led our group and given a lot of perspective. And we've always used, at least in most of our models, some of the funds that he has recommended and coached us on. So we want to, without further ado, bring Meg up.
Great.
Thank you for coming in.
Howard, thank you. Can everyone hear me in the back okay?
Yeah.
Yes? Okay. I hope what I share will continue to keep that smile on your face. We're off to a really good start with the food, yes?
Yeah.
If we can, I know Dan's gonna be speaking here in a little bit, but maybe a round of applause for Harry, for Jared, for Carolyn, and the entire team for what they put on today. This is really, as Carolyn had mentioned, my name is Nick McCreesh. I represent Capital Group and the American Funds, and I know many of you in the room have been invested with us, whether you know it or not. Our organization has had a great long-standing relationship with Harry and his team for not just years, but decades. I think back to 30 years ago. If we give you a minute or two to think where you were 30 years ago. Maybe the color of our hair 30 years ago. By the way, I don't say I color my hair, I put goop in my hair to help color my hair. But I think 30 years ago and where the markets were, maybe we can get into this in just a couple of minutes. That was the mid-90s. And if we think back to the mid-90s, anybody remember what was going on with regards to technology? Right, the early adoption of the internet, and I'll get into this here in just a minute, but amazing. The innovation, the companies, the forward thinking of well-managed, well-run companies and the wealth creation. But I also think back to Harry and the team of over those years and over those decades, what he and the team have been able to do, and it would be this lighthouse here in the background. And I'm going to oversimplify this, and I hope when I finish, maybe in about 18 minutes ago, you might say that that guy from American Funds was pretty darn simple. But I think about Harry and the team of being that lighthouse. Not every day is sunny and bright. Not every area of the water, the ocean, any waterway looks that good. There are times when there's chop in the water, when there's high winds, when you need guidance. And those that work, those lighthouses, it might seem like a really easy and slow job, but it's very, very important. And I think about, as was pointed out, the brochure here, and you don't have to pull it out, you're eating, but I love this, the words of worry less, enjoy life more. And I think about that picture of the lighthouse of everyone here at Financial Independence Planning. So thank you for having Capital Group and American Funds as a long-term partner and a friend to your organization and clients. So thanks, everyone. I was reminded this morning, my wife and I were talking about this event, and my wife reminded me of this Microsoft study, and some of you may have seen this. Microsoft recently did a study on attention spans. Has anybody seen this? Just by a show of hands, attention spans. Microsoft, Harry, seen it? All right, I'll make this quick. The average attention span of a goldfish, how many seconds do you think? 1, 3. It's 9. Anybody want to guess what a warm-blooded human being, the number of seconds your attention span is? It's 8. So I'm going to start talking really, really fast. If I can, you think about that study, and I'll oversimplify this. Attention spans have become really, really short. Maybe we can thank devices like this. We're getting so much, and everything is breaking news. But you think about your to-do lists. I hope your to-do list, not the stuff around the house, but more about the travel. And I think about some of the postcards and letters many of you have sent to Financial Independence Planning. But how can we help with this when we think about our economic forecast? Let me just give you a big picture view of the markets over the year. Raise your hand if you think that the stock market has always been volatile. I just showed you the answer key. Everybody's hand should be up. Okay? I just heard brutal. It depends. The ups and downs of the markets, the emotion, the heart rate, Think back to that lighthouse. Worry less, enjoy life more. This is a snapshot. It's in your folder. You don't have to pull it out. I hope that you can see it. But this is a snapshot of the stock market, defined as the S&P 500, the largest 500 companies in the United States, going all the way back to 1954 in the bottom left-hand corner. So when I say as an understatement, has the stock market always been volatile? The answer is yes. How many of you have said to yourselves, when the market is doing what it does, the ups and downs and the sideways, it's different this time? No one's going to raise it. But one, thank you. You're the only brave soul. It's different this time. Every day, it's different this time. The news or the noise, as I like to say, you've got the best hands on the wheel with your advisors helping you manage through, because there is always volatility. Let me quickly show you here. The blue bars up, the gray bars down. The dark part of the blue is the actual calendar year return of the S&P 500 when the stock market was up. If you were looking for some more good news, 70 years, 51 of those 70 up. That's pretty good, right? Lemonade. What about those 19? When you have those dark gray bars, when the stock market's down, when you go back to a 2022, stocks and bonds both down double digits. My mother's first year of retirement in 2022. Her expectation of the first couple of years of retirement, think about what she was coming off of. 2019, we had COVID, quickest recession in history, quickest snapback. Okay, things got better in 21. Maybe some of you were feeling a little uncomfortable, but you think about the market and the cycles that it works through. Every time that the stock market has been down in history, 100% of the time, it's always come back and it's gone on to set new highs. This is where we get challenged. 5% declines, 10% declines, 15 and 20. The larger the number, the more anxiety, the louder the news, the more pings that you get on your phone of breaking news. Is all of it relevant to you? No. It causes a bit of anxiety at times. We certainly recognize. Organizations like Capital Group, American Funds, and PIMCO, and most importantly, your advisors help manage to this. What's important to you in managing through that? I just wanted to share this because this is the only thing I can guarantee going forward. The stock market will always continue to do this. But I promise you this, 3 N's. If you remember anything that I said, 3 N's when it comes to the stock market. 2024, 23, 22, 25, 26. The stock market volatility, it's natural, it's normal, and it's necessary. It's natural, it's normal, it's necessary. 3 N's. Everybody good with that? Yeah. Okay, let's keep going. Someone just mumbled under the breath, goldfish, goldfish. Okay. I'm moving. Here we go. Has anybody seen, show of hands, the movie with Brad Pitt? My wife was in the room. She'd get a smile. Her ears would perk up. Brad Pitt, Benjamin Button. Anybody see that movie? Okay, there's actually a couple men that raised their hand. That's good. Yeah. Brad Pitt, a number of years ago, was in a movie called Benjamin Button. And if you remember or heard about this premise, it was that he was aging in reverse, if you remember this. Kind of a neat concept. I'd sign up for that. We think, here's some more good news, that the economy is aging in reverse. Here's some good news. Not back to a specific point, but here's some good news. If you take a look at how the market moves, and it moves in 4 different cycles. Early cycle. Early cycle, the good part about early cycle economies is that you're coming off of a really difficult low. So you're starting to come out, and many investors don't believe that it's going to get better. So think about those years of 2009, 2010, coming out of the global financial crisis, they were still concerning times. That was early market recoveries. Then you move into mid-cycle when profit margins are peaking, when the employment numbers start to improve and credit demand starts to pick up. Then you move into that late cycle, and by the way, those numbers above show average annual returns going back to the mid-1970s. Averages. You start to move into late cycle, and you see about a 9% return. From our economist and what we're seeing, and we don't have just one opinion at Capital Group and American Funds, we have over 400 people in our investment group in 14 offices around the world that visited face-to-face 21,000 companies last year on your behalf. I'm rounding down to keep the numbers simple. So we think where the economy is in a good position. There's never perfect, as we saw on the previous slide, but in a good position. But looking out, with inflation starting to come down, and it's sticky, with employment that's stable, with the Fed and the outlook, and this is not a prediction, Dan might talk a little bit about this in fixed income, with the Fed on pause, that we feel that we're moving a bit back, which is good from that late to mid-cycle economy. That's some good news. Said another way, that we feel that this equity market, there's always going to be volatility, but still has some room to run. And in terms of that, we talked about 3 N's, natural, normal, and necessary. Some of you might be thinking, but what about that R word, that recession? They're natural, normal, and necessary. Also, it doesn't mean we have to like them. There's always going to be the next recession, but we don't see another recession for another couple of years based on where we see the economy right now. Good news, right? Okay, let's move forward. If you look at this for any more than 25 seconds, you're going to get a headache. Let me just point this out, and I think it's the obvious. The size of the dot is the size of the economy. Where you want to be in the top right-hand corner. These are in terms of countries and the size of their GDP and their commitment to the economy. You can see that the US is the largest. You want to be in that top right-hand corner. Resilient growth and long-term tailwinds. The difficult is down here towards the bottom. China. We've heard a lot about China, right? And some blinking lights there. Slower economy, much different than ours. Communist, they have levers that they can pull. But if we think about the drivers of growth and what we see going forward, think about that top right-hand corner. By the way, folks, at Capital Group and American Funds, we don't invest just top-down in countries. We are bottom-up and we focus on companies. Are there very good companies in Europe that are doing great things, that have great returns for investors? The answer is yes. Interest rates. Dan's going to spend maybe a little bit more time on this. Let me just give you a couple of ideas. Does anybody know if the Fed is going to cut rates this year with certainty? No. Anybody know if they're going to pause throughout this year with certainty? No. All right, here's the third bucket. There's been a lot of no's. Does anybody know if the Fed's going to increase rates this year with certainty? We don't know either. You have a lot of people on television. There's a lot of articles on your phone that will tell you with certainty what they think is going to happen. This is why our firm, Dan's firm, are active managers. We're out meeting with companies. We're out meeting with government officials. We're talking to the Fed. We're understanding the best of our ability so that we can make changes to portfolio, again, to help you worry less and enjoy life more. But to give you a little bit of confidence, going back many, many decades, there have been 7 periods that the Fed has been easing. If you think about the top here, non-recessionary cutting cycles. So of those 7, there have been 3 that have come in non-recessionary times. We think we're in one of those right now. So if we took a look at that and you looked at the US and international stock market, you look at fixed income and cash, would you say to be a long-term investor is a pretty good place to be if the Fed will be cutting rates? No one's saying when, but if they're going to be cutting rates in the future. Pretty good. Well, of those 7 times, there's been 4 periods where the Fed in recessionary times has cut rates. And you take a look at that, when you go into a recession, difficulty in terms of profits of corporations, the unemployment numbers change, very different from that first slide that I started with. And you can see how that changes. US stocks on average have been down 3.5%, non-US a little bit more, fixed income being up. Here's my point in this. No one can predict the future. This is why we're active managers, to be able to manage to it, but a balanced approach in portfolios. High quality equities and high quality fixed income to create balance. Couple things. I'm at third base, I'm coming home. Good economy. Market volatility, natural, normal, and necessary. Balance is important. Let me ask you the question as I flip forward here. As I try to flip forward here.
Yeah, we'll just get it for you.
Go through a couple more. I'll tell you when. Here. How many times in the past couple of years, maybe this is just 2023 and 2024, when you heard the Mag 7? All these companies have had volatility over the years. We own these companies, but not nearly the size of the unmanaged index of the S&P 500. These cycles tend to move, and they do move in cycles. And I just want to share with you as my last slide here, and I'll close with a couple of final thoughts. But think about these mega trends that we talk a lot about, and maybe some of you do as well. These mega trends and how maybe early on in these mega trends, what do we see, what do we read, what do we hear in the financial news is sometimes we tend to overestimate the near term based on the euphoria of nothing can go wrong with this company or this investment. And then we learn through the cycle. So we might tend to overestimate early, but underestimate in the long term. And I started with this 30 years ago, the internet. Megatrend, PC users in 2000, the initial forecast was 225 million. The actual was 354 million, an underestimation of 36%. Can we go throughout a day without logging in, doing something on this? It's really difficult to do. Second here, the internet. Users in 2000, 152 million, underestimation of 58%. My goodness. Mobile. Smartphone shipments in 2013, 657, and you take a look at that 36% differential. My goodness. Some of you in the room might be guilty of not just owning one phone, but maybe owning 2. Think about your tablets. Think about your iPads. Just amazing. And then finally, think about the cloud. The top 3 cloud providers' revenue in 2020, 90 billion versus 150 billion, and we think that that could continue to go up and up and up. These are themes that we're excited about, the opportunities that are in front of us. We think that there's opportunity as active managers. Natural, normal, and necessary. Good economy. Balance in portfolios. And here's the last thing that I would share with you. And Mike, thanks for helping me with the slides. The last is the letter T, and that's trust. And the trust that you have with your advisors in financial independence planning, and you flip that around of the trust that they have in you and helping you worry less and enjoying life more. So on behalf of Capital Group and American Funds, Harry, Jared, and team, thank you for having me, and thank you all being investors and long-term investors. Thank you for the time.
Thank you, Mick. So, lunch will be served shortly. Can you hear me now? And we always bring up 2 speakers because it's just like a debate, right? One's got one opinion, one's got the other. So Mick's from what we call the equity side. So you know how you have your models. You hear Jared and I tell you have a 60-40 or 50-50. So that's 50 is the percent of equities, And, like the ones he talked about, which we backed up on card and NVIDIA. And then there's the people who put on those breaks and there's the bonds and cash. So we call them fixed income. So Dan is, our man of the hour with a fixed income. He is, comes to us from PIMCO, which is, I don't know, $1 trillion,
$2 trillion.
2 trillion. I'm behind the times already. So, he's also been a bulwark and a real buttress to some of our funds and helped us during, to allay the up and volatility, of our models as well. He is I can never identify what's he is certified,
Certified investment.
investment management analyst, so he's SEMA certified, he's super smart. Usually I do a Zoom call with him, I'm like, lost in the waves. And then he has to, do tell me like 101 investments, so that's great. So, but I love Dan, and he's, I think he'll share, he does not talk over our heads, he only does that to me. So, so he'll simplify for all of us, and he'll talk to us about fixed income. So without further ado, Dan.
Greatly appreciate. Thanks for the next intro, and thanks to my good friend Nick. Thanks. I was saying thanks to everyone. Thanks to my good friend Nick. He is always a hard act to follow. So I got the short end of the stick, and he got to go first, which I'd rather go in front of him because he's always so good at what he does. Congrats to Harry, 30 years. That's how long I've actually been in the business as well. It's amazing to see what he's built. I've been along the ride with Harry and team for over 15 of those years working with him, and he's been working with PIMCO prior to that. So it's great to see Jared and how he's running the company now. And I remember when he got into the business and knowing him before that. So it's just great to be here, and it's great to be here in person. I got tired of those Zooms, no offense, but right, we all did. You saw me on a screen, saw all your checkers, and done so many of these over the years, and it's really great to be back in person. So thanks for your time today. Yeah, as Caroline mentioned, I'm with PIMCO Investments. We have $2 trillion roughly in assets, which when you think about it is bigger than most banks out there. And we take it very seriously. The company's been around well over 55 years. Most of our assets fall into the fixed income category, although we do have a decent amount of equities. But people typically think of PIMCO for their fixed income or bonds. So today we'll talk a little bit about fixed income and bonds. And I guess I should have asked someone to the right.
The big one in the middle.
Yeah, it's not working. But, no problem. So we'll talk a little bit about fixed income and the bond market, a bit on interest rates and things like that. I find it, Caroline's comments, that we always have two different opinions, but listening to Mick and his great company, American Funds, a lot of our views are I think, the same. We're not calling for a recession. And keep in mind, bond investors are pretty pessimistic. Right? The glass is always half empty. But we don't see a recession out there either. We'll talk a little bit about interest rates and things like that, but bonds have a really unique part of people's portfolios. Certainly when it comes to age, right? Bonds are typically less risky. The older you get, typically the less risk you want. And they've done a very good job, which we lost for a little bit there, of the negative correlation between equities and riskier assets, but it's been back. The most important thing about fixed income, we would say, is what you haven't seen for a lot of years is you have yield again, or your coupon, your monthly income, which we'll hit on as well. Bonds are yielding a lot more than they have over the last decade, which is a very, very good thing for fixed income investors. Mike, sorry. One more. All right, so the three things you probably want in fixed income. One, as I mentioned, income and returns, right? You want that monthly income. If you can get positive alpha returns on top of that, it's always a good thing. In the middle there, preservation, right? Typically, certainly if you're invested in the US debt, you anticipate you're not going to get any type of defaults, right? The government's not going to default and not pay you. It preserves your money. And then thirdly, your diversification, as mentioned, if you're using other asset classes like equity, fixed income can hopefully be negatively correlated to that, or at least diversify your portfolio, which I know here, as Jared talked about, right? Long track records, like senior models and analyzing your models, very, very diversified approach they take, which is a very good thing. Like one more. So as I mentioned, yields are back. So the checkered part of each column there is the end of 2021, where yields were in those different categories. And don't worry if you can't see all the categories and it is in your pocket, don't need to pull it out. But as you can see, the solid bars are as of the end of this December. So you can see the difference, the contrast between how low yields were, the checkered or the lines versus the solid. Yields are much higher. And that's very important because the longer you're in investment, the bigger part of your return comes from your yield or coupon. So a total return in fixed income is comprised of two things: price appreciation and your yield. And the longer you're in an investment, the more that yield helps. So yield's extremely important. And once again, yields were very low for the last bunch of years. It was a bit painful. Maybe talk about 2022 when these yields rose, and it was an anomaly, right? The Fed raised interest rates very, very quickly, a lot, and you felt it. So 2022, depending on what type of investment you were in fixed income, the ag, which is unmanaged, and we would argue not a great investment, and it's a passive approach, was down about 13.1. Other fixed income might have been down 7, 5, 4, depending, but it was a tough year. But the good news is that's behind us. Yields are much higher. 2023 was a good year for fixed income. So once again, sometimes you have to go through a little bit of pain to get to the final destination. If you can move it, Mike, to the next one. This is really interesting. What it's saying is that your starting yield or yield to maturity in fixed income, so the coupon, let's say you get, just making up an arbitrary number, let's say your investment's giving you 6%, your starting yield is 94% correlated to your 5-year return. So meaning you can anticipate, once again, no guarantees, but roughly if something's yielding you 6%, your return annually for the next 5 years should be somewhere around 6%. If it's yielding you 4%, it should be roughly 4%. But once again, you can see current yield, and once again, this is through the end of the year. That's of the ag or the 10-year, 4.9 as of yesterday was roughly 4.5. But you can see in other areas that yields were much lower, and they rose up now. Once again, yields your friend and should help you with your future return. Once again, very interesting. The blue here is roughly showing you the 10 and 90th percentile range of the Barclays Ag, when the Barclays Ag starting between 4 and 5%. What the yellow, what the line across the middle is, the gray line, that's your average starting yield. And then for the 1, 3, 5, 10-year, the blue dot in the middle is the average return. So essentially just more, once again, reiterating, it's pretty close, right? The average yield is coming in pretty close. It won't be exact to the average return and average yield. So once again, it's a very good predictor. And then you see on the bottom, percent of rolling periods with positive returns, pretty good, right? Positive returns, the 3-month, 71% of the time. Now, 3 months is an extremely short time. We're investing for very long time periods here. But even in a 3-month period, 71% of the time was a positive return. For the 1 year, once again, very, very short time period, 95%. And then for the longer, 100%. So once again, fixed income, as Mick showed you, equities, the longer you are, not panicking, which we'll show you there, and Mick showed you the volatility before, staying put to the course. And I know you guys changed, Jared, what you were doing, but I always loved the roadmap you guys always showed with along the journey, right? Always staying part of the journey, which FIP is certainly does for you with financial planning. You got to stay put. Next, this is showing you a little bit about the Fed. So essentially, cash outperforms bonds in a rising rate environment, which we went through a few years ago, right? So cash does tend to do better. However, once the Fed begins their cuts, which we know they already have, fixed income outperforms cash by a lot or tremendously. So on the bottom are the months after the Fed cut starts. But essentially, you can see that those high green bars typically do well in fixed income 1 year on the left. So it's showing you excess returns over cash. So once again, to Mick's point, I can't tell you, and once again, we run $2 trillion. Mick, they run trillions of dollars, what the Fed's going to do. And guess who else can't tell you? The Fed. They don't know what they're going to do. And here's why. The Fed's an academic body, and they look at two things. They look at it as a gauge, inflation, which they've obviously been trying to bring down, and unemployment rate. And they're data dependent. They go off data. They're not political. Who's in the White House doesn't matter to them. They're academics and they look at data. And what the data tells them and how they interpret that is what they're going to do. So to Mick's point before, we don't know, no one knows. Do we have a pretty good idea? PIMCO does. One of the people at PIMCO was second in charge at the Fed. Rich Clarida, his name is, he was the vice chair. He was with PIMCO, left, was with the Fed for 4 years, and then came back to us about 2 years ago now. Ben Bernanke is a consultant to us, prime of Fed chair, and then around the world, other people that have ran central banks are on PIMCO's global advisory board. So we have a very good idea, but no one knows for sure, right? A lot of people have gotten their calls wrong. Might give a move to the next slide. So Mick mentioned, are we going to, or is the Fed going to cut? Are they going to raise rates? Are they going to, keep rates higher for longer? That is PIMCO's, I would say, base case view. That's not to say you can't see the Fed cut 1 or 2 times this year. We think that's a possibility. Once again, we have a new administration. There's new data. There's new things being done. They're going to sit there and interpret that and see how the economy acts and how things happen, what happens with unemployment, with companies. But as I mentioned when we started, we think things are pretty good out there. How many of you are, if you had to take a guess, are probably going out or eating out more now than you did prior to COVID? Right, I'd say most people, half at least. I mean, I would argue if you looked at the population, I would say it's more. What Nick and I do, we're out a lot. Restaurants, breakfasts, dinners, lunches, every place is packed. It's amazing, absolutely amazing. I fly a big amount. Airlines, can't even sit in airports. It's like unbelievable. And are prices lower? No, right? I think eggs hit an all-time high yesterday, I read. The cost is astronomical. Now, what's happened, right? COVID, I think, shifted people's mindsets. Maybe people or your children or whomever might have this approach. I think my parents do. I'm going to enjoy things a little bit more. If I spend a little bit more money and vacation maybe a little bit more, or eat out a little bit more, I'm going to enjoy myself, right? Obviously, COVID was devastating on, obviously people losing their lives, but people were cooped up. You couldn't go out, you couldn't do things, you couldn't enjoy the hard work and the amount working with this group here to save the money that you have to live and not worry. So people want to do more. So the economy seems to be doing very well. So we think we're in this higher for longer, and that's to the left, the pink. But the returns here, different asset classes, the pink is to the left side higher for longer. So that's where we're looking. But if you look at different asset classes, no matter if it was higher for longer, an immediate cut, which we're not thinking about, or an emergency cut, which we've been through, not going to happen. But if you look at higher for longer, that happened back in 1995, actually, as we're talking about 30 years here. So no matter what asset class you were in, things did okay or did pretty well. And once again, higher for longer doesn't mean the Fed isn't slowly going to bring down rates. But keep in mind, cutting rates is done to stimulate an economy. So if we do have an economy doing well, depending on, once again, what happens with the administration with different things, tax cuts or whatever, they don't want to overstimulate if things are good. So it'd be hard to bring down rates, but we'll see what happens. Next slide. If I showed you this slide a few years ago, there would be a lot of red. So what it is up on top is different asset classes, and this is just categories not actively managed. This is just asset indexes. On the left is if interest rates got cut or interest rates were changed, risen or raised. As Mick said and showed you, it's pretty well known. It's an inverse relationship. So if interest rates are being cut, bonds should do better. If interest rates are rising, bonds typically have a harder time. Not to say you can't be positive, but it's more negative. So once again, red, which is meaning you would lose money, it's a very small portion. Essentially, what this chart is showing in two columns for fixed income and investment grade munis. If rates were to go up 3 to 1%, which is a lot from the Fed moving rates, you could possibly see some losses. And once again, this is not active. Active fixed income managers outperform tremendously. And I'll show you that in a minute. But if rates were just to stay the same or get cut or even go up slightly, you can still do well in fixed income. And once again, I think we should do this. We should probably add the old chart from 2 to 3 years ago. There was a lot of red out there. So things look pretty good once again for fixed income. Once again, why is there so much green? Because you have a lot of yield, a lot of coupon in your bonds, which protects. It's a buffer. If rates were, if your bond were to lose a little bit of value, well, the coupon of that yield protects you. So it's an interesting chart. Thanks. So Mick, you showed something similar to this. High yielding bonds are inversely historically correlated to equity. So when equity, the down parts, the pink, are down, your fixed income or treasuries have done well, a buffer, right? You want a diversified portfolio. If everything in your portfolio is working at the same time, what do you think is going to happen when things don't work, right? They're not going to work. Like 2022 is an anomaly, but essentially if everything is doing great, you might want to say, wait a second, because at some point, if things all do bad, it could hurt. So bonds work inversely typically to equity and are a great buffer, and that's why you want fixed income. And they shouldn't perform as well as equity on good years of equity. This is real interesting, as Mick also hit on, volatility. So what this is showing you is inflows from retail investors like yourself and what they do. So the green line up there is the Morningstar category of what goes into, let's say, mutual funds and ETFs. And what happens is as things are good, everyone's happy, right? I'm so happy I invested when I did. There's been such a good recovery. But what happens as things are not doing as well, and this is why it's crucial you're working with FIP, is this won't happen, this won't last, I gotta get out, I can't take it. I better get back in, right? Once you get out, okay, let me sell at the bottom. To Mick's point once again, in March, what happened? People, hopefully not you because of your team, panicked. It was 3 weeks, the markets dropped 2,000, 3,000 points, I think it was in a day. If you panic, in 2 to 3 weeks, you were above where you were. So what happens is you panic, you get out at the wrong time on the bottom. Things go back up and you say, oh, everything's great, let me get in. Well, you just missed all that return, right? And if you're doing this on your own, which obviously you're not, if you're here, that's not a good thing, right? If you miss a little bit of the returns or a few days of those returns, it can change your portfolio dramatically. So once again, you want to stay invested. The pink line's that emotional investor, and they actually finish roughly they were worth 99,062 versus the person that's working, let's say with a financial advisor staying the course, you have a 122,166. That's a really big difference. Thanks, Mike. This is just showing that active management, which obviously PIMCO does, American Funds does, but really outperforms in fixed income. The average equity manager, this is showing large cap blend, only 13% of them can outperform on the equity side. It's a hard thing to do. There's not companies that can't do it, but it's a hard thing to do. There's many reasons for that. In fixed income, it's different. You can't replicate a fixed income indices. Indices or passive fixed income can invest in new issues. It's a tremendous bond market, way bigger than the equity markets. So there's many reasons, but 85% in the intermediate core managers can outperform. And, obviously we think we're better, and our record, typically shows than the average. So we think we can do even better. And these are just really some quick differences, right? The S&P 500 stocks, there's over 10,000 bonds, right? You can't possibly just go buy 10,000 bonds as an individual investor. Turnover, the different types of exchanges and things like that. Yes, that's it, just some of the definitions. But in general, our message, I think, is pretty much the same. You have to work with a great team, which you already are doing. You have to be diversified. We know you already are because we work very closely with this team. You have to stay invested. You can't be emotional. You have to be we would argue it's good to be with active managers. And at the end of the day, it's not worrying about it, knowing things are set, enjoying your life, and enjoying the fruits of your hard labor for your whole life, working to save money, to invest, to plan, whether that's to spend it now, to pass it on to children and grandchildren, but to enjoy things because this part of your life is taken care of. So thank you very much. I appreciate it.
The first presentation, you had a slide that showed the cycle of going from early to mid to late to recession.
Yeah.
You said things have reversed.
Yeah.
Yep. I'm a physics major, so I always want my slides to go to the right.
Yeah.
Why did things reverse?
Yeah.
What do you think is causing that?
Yeah.
That seems to be fighting the historical trend.
Yeah. Do you mind if I try to repeat
Yeah, repeat
the question? And keep me straight here. So Bob, it was Bob, correct?
Yes.
Bob asked the question, if you remember this slide, I said Brad Pitt, Benjamin Button, an economy that's aging in reverse. Bob has a physics background and said he likes the motion to be going this way, not in reverse, and completely agree. That's a big reason that we put the slide there. It's contrary to what we're used to. Is once the economy starts moving this way, it's like that wave that continues to go and then we go up again. What's the reason? And it's a couple of reasons. Is you think about the starting point of this economy, think about where we were. Coming out of a period of COVID, right? Fastest recession in history. A lot of money from the government that was pushed to businesses. No one was spending. We had a pent-up demand. Interest rates were cut. Said another way, and you've heard this term, there was a lot of money that was moving around in the system. Then all of a sudden you got to a period where inflation was going up so quickly and is still sticky, as Dan had pointed out. But the Fed started to raise rates pretty darn quickly in 2022. We hadn't been down that road in a long time. The Fed has been very thoughtful about slowly moving these interest rates down, and now they've paused. So I hope I'm walking us through where we've been, what's going on in the economy, and how can this economy be aging in reverse, maybe be getting a little bit stronger. Because the Fed has done some really hard work. It was painful in 2022 when rates went from zero and they went up significantly. It disrupted not only the bond market, it disrupted the equity market. But now if we look at at the economy going forward is the Fed has started to move. Inflation has been coming down. Employment has been pretty stable. And that brings us to the point of we were moving towards that later stage. But now we're moving backwards because the Fed's on a good plan. Inflation's coming back down, but the good news is that the employment numbers have remained fairly consistent. That we haven't seen a lot of movement. So the point is that what we were coming off of, this corporate profitability was pretty darn high coming out of COVID. But you look at the employment numbers, companies were doing more with less. But all of a sudden, as businesses continue to move forward, you need more employees. And we've got a more stable Fed and a more stable economy. That gives us the optimism of what we're looking at of a more stable equity and fixed income market going forward. Thank you for the question. All right, the hardest one is out of the way. Bob was the brave soul. He asked the first question. Thank you. Yes, sir.
How do you think tariffs, like 25%, 10%, will impact this movement, especially if it brings back some more inflation?
Yeah, I've got thoughts. I don't want to dominate. I want to be a good partner. Do you want to?
We can vote.
Okay, yeah,
All right.
yeah.
So I wish I thought about picking this up, by the way, off the thing when it's presented. So I'm not that smart. But yeah, so tariffs, work in different ways. PIMCO does believe that this administration will put on tariffs, and it could be happening as we speak, right? Today might be the day. But if you look back at his last administration, it was very targeted on what they tariffed. So the headlines did show there were tariffs on China, but it was very targeted to what was what was tariffed. And it didn't necessarily cause inflation last time. However, he is talking about 25%, and we'll see what the numbers are on Canada. We do import about 81%, I think, of our oil from there, and Mexico and things like that. So it could certainly help with the deficit, right? We have big deficit. Tariffs can, certainly help with that. But the other thing is they could cause inflation. We do know, President Trump, one thing that he uses as a barometer to success is the stock market, right? He likes the stock market doing well. If tariffs were, and not to say, who knows what's going to happen going forward, but chances are he probably wouldn't want to see the stock market going down, right? Because he likes that as the scorecard. So he probably has that in the back of his mind as well. If tariffs are too much or what have you. But to your point, it could cause, and then that's why we said the Fed doesn't know, right, what to do, because it could cause inflation. There's different percents he's throwing out now. They're talking about 10% China, 25 Canada, Mexico. We'll see. We don't know. Could they be on? Could they be off? These other countries are saying they would retaliate, which, is another, could be a concern, right, for us, because inflation could get higher, obviously, if things cost a lot more for us to buy. So it's really, literally today might be the day where we see something, but it's out there. We don't know what's going to happen with it. Could it cause inflation? Possibly. Could it not? Possibly. Is he going to do is what he says, but we do believe he will do tariffs. If you look back from 30, 40 years ago, he's a big believer that tariffs work. So we'll take it from there. We'll see. But I don't have anything else.
And I know, right? If anybody's checked their phone today, the tariffs, right? It's early and no one knows. It's early and no one knows. You think about being active in portfolios. Our firms have warm-blooded human beings that have a lot of experience that have been through periods where there have been tariffs under different administrations in the past. Wars, high interest rates, you name it. This is just another part of the cycle, and the news is new. No one in here is going to make an irrational decision, but here's what I do know for sure, is that well-managed businesses have been through difficult periods in the past, where the news seems We haven't seen this before. We have seen tariffs before. And what do well-managed businesses do? There might be short-term volatility, but given time, you look at where they were versus where they were at the end of whatever the news cycle, well-managed businesses, most times are moved higher. I would also say on the flip side of it, the companies that haven't made good decisions with their balance sheet, they might be leveraged or in a more difficult period. And that can be difficult for them. And it's incumbent upon organizations like Dan's and PIMCO and Capital Group and American Funds to be not only meeting with these companies, but understanding them and asking the questions, getting ahead of it. What is your preparedness if there is tariffs? From a balance sheet perspective, what is your opinion if this happens? So when we talk about research and going through periods like this, short term, give it time. This is not new this time, but it's new today. You have thoughtful, experienced managers that are working on this as we. Very good question.
Are there any other questions? Sorry. Oh, Zoom attendees, are there any questions from the Zoom attendees? Oh, you'll have to let me know what the questions are. We did get some questions when we sent out the email from people that are not present today here. And one of the questions actually came in quite a few times. And so we'll let both of you take that. I'll try to paraphrase the way it was phrased in several different ways. AI seems to have taken away some jobs, and yet it has, and yet everyone says it's going to stimulate our economy. So how does it do both? And what will be the impact for 2025?
I'll go quickly on this, and I just tend to think AI and stuff falls more with equity, but essentially, yeah, some jobs could be lost, right? We've seen the robot that makes pizza now or whatever it does, and I was in LA a few weeks ago, and I have it on my phone. I can show you. This little robot came by delivering something, and one of those Waymo cars drove by with no one in it. So yeah, there are certain things, right? Warehouses in Amazon and big warehouses might have robots and things like that. So there definitely could be some job loss because of that. Hopefully those people that lost their jobs can be retrained or skilled in another area. But overall, which I think everyone says, productivity will increase, right? You're not going to need 50 people analyzing spreadsheets when a computer can do it in 1/100th of a second or whatever it is. So overall, it's a very good thing in general because we all hear about what it can do in analyzing for disease and every aspect of every company is using it and starting to. So overall, it's a good thing. Could some jobs be lost? Sure, it's possible, but we would think those people could be retrained in another area. And overall, make things much more efficient and productive.
Very well said. I just had my cardiologist appointment yesterday. Anybody that's had a doctor's appointment, I feel more comfortable now with just starting to scratch the surface of AI with what doctors, Dan and pointed out, surgeons, physicians have access to faster, to go deeper. Now, the length of those appointments might be shorter. Sometimes it's almost embarrassingly short in the past, but think about the levels that those doctors can go. From what they know walking in, the charts that they can read very quickly, to the output based on those of us that are sitting in those rooms in the site. You think about AI, there's been a lot of talk about weight loss, right? Think about MS and cancer and these really difficult diseases. As AI can be turned to focus more on those that we've got a pretty good runway here with weight loss. So the opportunity just in terms of the medical field is fantastic. But think about warehouses and manufacturing. I think about the employment numbers, they're going to roll, and that's What's always happened, if you remember back to the mega trends slide that I showed, the early adopters of the PC, who would have thought? And how many times back in 2000 did some of us in the room think, it's all going to be the computers now? They're not going to need us. And then the use of the internet. That food is being delivered by a robot. That you're sitting in a taxi cab with no driver. Who would have thought? What's next? Amazing, but think about what's next. So the companies that are out in front of this and adopting, not jumping 2 feet in, because no one knows where this goes. It's like a planet that's being built, but nobody's been to yet. But is it helping certain industries? And I'd ask you to just come back to the medical field and how this can move us forward very, very quickly.
Even our industry, right? They're coming to life, it's huge.
Helping analyze the data to help all of us as investors.
Thank you. Thank you very much. Well, actually, I was in a driverless taxi, and my kids actually said, this drives better than you, Mom, so. I'm all for the driverless taxi. So, any other questions? Yes, Harry.
First, I want to say thank you all for being such long-term value client. Appreciate you, appreciate all your referrals and all of your suggestions to help improve the company for 30 years. So I do want to give you all the for organizing this live event, and we're going to have several others here. It was finalizing the details on that, so you're welcome to attend and also to bring friends. We'll have more space next time, but it's great to see everybody. And we've met with you guys, and we were just San Antonio with the Terrace Top people. We're hearing the couple of things for this year that the market's going to be volatile, but positive for the next 1 to 3 years, and there's going to be an adjustment, which is normal. There's normally like a 10% drawback, which you hate to see that, but that's part of growth, So I just want to hear your summary of 1 to 3 years and volatility and maybe a 10% drawback, which is normal. Not
Addressing the drawback.
Yeah, so pullbacks are always great, right? Or not great, but needed as your point to grow. So at PEMCO, we don't really forecast that far out because we believe it's very hard to tell, right? But we would think single digit type returns on the equity markets as well as fixed income, single digit returns as well going forward, with more volatility, as you said. But once again, stem the course, things come down, buy more. The chart Rick showed, right? The equity markets, when I started 29, 28 years ago, whatever it was, I remember sitting down, there was one TV, one computer that everyone shared. And I remember everyone crazy because the Dow hit 10,000. I forget, it was 95 or 96. I forget exactly what year that was, 98 maybe. Today, we know where the Dow is. So, once again, could it be single digit returns? But how many people were calling for single digit returns last year going into the year? A lot of very smart people, a lot of very smart companies, big companies, and the markets were up tremendously. So, Harry, what you guys already do, as I mentioned, diversification, owning a lot of different things, not getting tied up in volatility, staying put to your plan, should do well. But, if we had say something, we'd say high single digit type of returns.
Real quickly, then I know you have a question, sir. So, coming back to it, I was stalling as long as I could, Mike, in one of your packets, and if you remember this sheet, this is the take home. Pull this out, not right now, at some point, and come back and look at the very top, above the blue bars. And it shows the average going back to 1954, so many decades. 5% declines, 10% declines, 15 to 20. I had said three N's: natural, normal, and necessary. History showing a 10% decline happens every 2.5 years, actually every 2.7 years. Anybody remember the last 10% decline? Anybody remember the last 5? Again, sometimes we scratch our head, and the stock market's always been volatile, but when does it hurt the most? When you have volatility to the downside. I would say, think about volatility. We had volatility to the upside the past 2 years. The S&P 500, last year up 25%, 23, up 26%. There was volatility to the upside. So 10% declines on average, expect every 2.5 years or so. But for every decline, then what happens next? The market rotates. The market historically has gone on to set new highs. I hope that's helpful. Yes, sir. You have
Back to AI, is there any concern about the dark side which scammers can use to, do their thing?
Yeah, I mean, I would just say this is more general, like with anything, there's always the nefarious, right? The people are always going to be out there, no matter what great things invented, to be the other side of it and use it for negative things. So without a doubt, just like anything that comes out there, whether it's the internet, AI, anything, there's always a flip side to it where the bad people, the scammers, are always going to find a way to do something as well. So that's something I guess that needs to be put in consideration, but I don't necessarily have anything other than that.
There really is an answer because, right, that's business. And especially when you're connected to technology and how quickly technology moves. But think about the next step of this. You think about companies that are coming up with software, let's just say to validate, right, the data in some of these technology platforms. So a validation software, I'm just keeping this really simple, would that help AI in the output that we might be looking for if we go into ChatGPT and ask a simple question? We might have a high probability of thinking, okay, that answer seems right, but how can I make sure that it's truthful? So I think about technology, and as quickly as it's working, a lot of these companies are also thinking about how do we defend against this? If we're going to put output, how do we defend the output that we're generating? Great question. Yes.
Do you see any bubbles coming?
Questions around bubbles coming?
So on the fixed income side, I would say it's a bubble, but we are cautious on private credit. So that's companies that invest, they're not going to the market, if you will, they're bonds don't trade. Now we're one of the largest private credit investors in the world, so I'm not saying don't own private credit, but that's the hot topic. There's, as Mick said, there's a lot of companies out there that aren't possibly in great shape, great standing. A lot of companies getting into this private credit space that aren't experts, that aren't huge. So, we would say it depends on what firms you're with, who you're dealing with. But, when you see a lot of money running to one place, I wouldn't necessarily say it's a bubble, but now, if you haven't heard of private credit, you'll probably start hearing a lot about it that I brought it up. Because it's out there, it's in every conversation, it's in the media. And once again, we run almost 200 billion in space there, so we're all for it. But once again, a company like ours that knows what we're doing, what we're buying. But yeah, I don't know if there's a bubble that we see per se.
I can maybe a couple of thoughts. When I think bubble, I think history. I think what have we been through where there are blinking lights? Let's just walk back a couple of years. The global financial crisis. Does anybody remember what was the tipping point of the global financial crisis?
Bear Stearns.
Bear Stearns is an organization, right? Fallout. The mortgages. Unfortunately, in business, in life, we learn through, we as human beings, businesses learn through mistakes. The mortgage situation, right? Much better situation where we are now. The banks have different regulations for that now. Let's go back a little bit further, the mid to late 90s. You put .com behind any name of a company, it was almost a license to make money. We don't see that happening. These technology companies, especially those that are starting to move down the road of AI, they're well capitalized. They have cash. They have earnings, more importantly. So I'm giving a couple of examples. Mortgages, banks are in a much better position. Go back to the previous one, the late 90s, early 2000s. Technology in a much better position. These companies have business plans. They have earnings, really, really good.
So we would say that, just, we're big believers that there's nothing else to take over for the dollar. A few years ago, there was a lot of talk about China, and then they ran into all their issues with their economy, as Vic hit on, and demographics and real estate and everything like that. So there really, in our eyes, is no, we're always the US, and one of PIMCO's founders said this many years ago on TV, saying, the US is the cleanest, dirtiest shirt. What's that mean? Your teenager wakes up, there's nothing in their drawer, they go to the floor in the corner and there's 5 dirty shirts, they pick them all up, smell them, look at them, and put on the cleanest one, right? We might have some issues as a country, we have a lot of debt, 37 trillion or so, but the whole world knows we're not going to default on our debt. We have a lot of it, but we're not going to default on it. If they invest with us, they're going to get paid back. We're a free economy, free country, everything that's so wonderful about this country. So to us, there's nothing else out there. Will there be other, even the US is looking at stable coins and things. So we do believe there will be some sort, and there could be some sort of stable coin even in the US or other places. But we don't believe it takes over for the US as the reserve world currency. But yeah, as things develop, it's just evolution, and blockchain, which you've heard of, is 100% for real. It's very real, and that's what crypto is kind of based off of. But we don't necessarily see like there's a coin or a meme or whatever that's going to take over the US currency at this point.
Great response. I know Jared has a question.
Any other questions? Because we're still taking them. I'm not here to interrupt it, don't worry. A lot of information, and I promise we just have one more hour of tax strategy. We'll get you guys out of here. But I mean this, and this is my last thing, unless there's other questions. What I love about working with firms like American Funds and PIMCO, we talk about this active management. As a team of advisors taking care of 800 families, we like to know that our clients' money's in the best hands, because I need to go to sleep at night, right? And did you hear what they talked about? What's going on in China? Inflation. There's 100 things. And what do I do for a living? Help you guys have better lives, worry less, and enjoy life more. And we do that through their funds. So I just want you guys to take a minute. A lot of big concepts we spoke about, the market, this and that, but this simple concept. While you're out having fun, these guys will explain the team that is constantly managing your money, being thoughtful and making the appropriate changes. So we're either positioned for growth and have that protection for decline. So just a brief talk about the management strategy. So when they're off on their having the next pina colada, they're like having fun. They're making sure my money's in the right place.
Great question, and I promise we'll wrap. I'm going to try to be a good partner. Dan's going to go first this time. Okay.
All right, well, thank you. So, yeah, at PIMCO, we have a whole process, and this was designed 55 years ago. So what we have, I'm going to start macro first. We have what's called a secular outlook. It's every May. and 253 investment professionals around the world come to Newport Beach. By the way, during COVID, it became virtual, but we're back to in person for that. We have 13 offices around the world, 3 in the US, a few thousand people. But all the investment professionals come together and we come up with our 3 to 5 year outlook. So essentially, that's, what direction are we heading in? Do we want to go north? Do we want to go south, east, west? All right, we come up with that. And how it works is for the first 3 days, as Mick said, there's not one person that's making these decisions. It's debates, it's presentations, it's in some cases arguments, I'm sure. But everything's being discussed. The next 2 days, we bring in outside speakers of people that we have interest in. So it's been top people at Google, people that run sovereign wealth funds or countries, prime ministers, Gordon Brown, John Trichet, Mark Carney, who's now running to be Prime Minister of Canada. Every year it changes, but we have these different people that are experts. It could be a defense expert we've had to get their views as well, to understand, what PIMCO might not, to come up with that 3 to 5 year outlook. Then every quarter, so 3 times a year, we do this again. It's a little bit shorter, but saying this was, we decided in secular, we're heading north, duration should be this, all the parameters. Do we still think, has anything changed in the last few months, right? Do we still think, is this what we want to do? Is this the direction? So that's like the big view, right? But then to break it down further, any of our portfolio management teams for funds, there's a team. There's not one person running, as Jared mentioned, the income fund. It's dozens and dozens of people that are portfolio managers. But under them, they then have dozens and dozens of analysts that are also experts on certain fields and companies and sectors that they're meeting with and talking to and discussing. So this all happens literally on a daily basis. Once again, as I'm sure American Funds is, these locations around the world aren't just randomly anywhere. They're in different time zones. So this is 24 hours a day, it never ends, right? If the US is out of work now, Australia's on, or China, or Japan, Singapore, Germany, right? So it's constant, it never stops. And there's people positioned strategically on these teams in all these different areas. So there's always people on these teams looking at things working and collaborating. And, we talked a lot about AI and technology. Technology makes this happen. We all learned from Zoom, right? Before COVID, who had ever done a Zoom? Right? How easy is that now to run our world? Okay, Bob has, but side thought. But, once again, that's changed the world. But even the trading systems and the AI and all that, we're using that internally as a company more so. So a quick example, right? When the Fed speaks, the Fed minutes come out. So what happened was back in the day, there was probably dozens and dozens of people that read every word of it. Now AI reads it in 2 seconds, or probably less than 2 seconds, millimeters of seconds, and analyzes it. In a second, you have all, the news, the reports, and what have you, what was said. So, things like that. So, but to Jared, your point, it's 24 hours a day, every minute, every second. These portfolios are being looked at, analyzed.
But more importantly, and back to Dan's point, AI is helpful. It can move things forward pretty darn quickly. To be cautious, what's real, what's not real, to have warm-blooded human beings.
All right, I know we're all itching to get out, and the good news is it is over. I just want to say a couple final quick thoughts. Real quick, I hope the whole presentation was great, but it's really important that last piece that you guys know, wow, our money, because again, most of you have 5, 6 different funds, not just in those 2, active management, being watched all the time, 3 other amazing managers just as good. Just as we look at funds track records, I'm almost done, I promise. I know, it's been a long day. We look at 20 years to say, hey, how have these funds done over long periods of time? Well, I look at that about our firm, 30 years. For 30 years, we've helped our clients stay on track to their goals. So as much as we have great management, we built a great firm to help people have ongoing great guidance. I look around this room, I think more than half of you are referrals. That's what's grown our business. We take care of 800 families. We want to double that. So again, if you do have friends, family, kids, brothers, sisters, I already know the level of service that they're gonna get. It's not a financial planning experience they want, it's the financial planning experience they never knew they wanted. Thank you again, you guys are the best. And appreciate seeing you all in person. Have a great day.